The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks. Welcome on back here to the Diagnostic Trading Hour. I hope you and your families had a great holiday season. So, still got a couple more days left of holiday with the New Year celebrations coming up. That does keep the liquidity quite low, which can cause some crazy sporadic volatility. So, just be aware of that. But it should start picking up this week, then next week, and then be full throttle the week after that. So let's start off just seeing where the markets are at right now. We got the S&P is down just a couple points on the day. The Nasdaq's down 5. We have the Russell up 1.4 and the Dow up a whole point. Gold is currently down $9 on the day. Silver is down about 2%. Copper is flat on the day. Oil is down $1, down 1% right there as well. So we got some movement over in the commodity section here. We got corn is down about 4 points, which is almost a 1% move on corn. Soybeans down about 11 points. Euro dollar is currently, let's see here, we got euro dollar currently up at the moment around 58 pips. Pound dollar is up 32. Aussie dollar is up 46. Euro yen's up 50 with US yen down 13 and pound yen up 28. Dollar CAD currently down 62 with the dollar franc down 42. And basically, King Dollar is getting smashed at the moment. So everything pushing it on down. What could be causing such a thing on such a quiet Monday morning? Well, I'll show you. And this is in. I don't know if I was just the only one, but I think I heard them say something about the word taper. I don't know. Maybe you heard that too. I don't know. Anyways, let's go over here and check out the New York website. And go to markets. We'll go to open market operations, and they're gonna taper 10 billion off the 85 billion they're doing. But let's look at what they're doing in this overnight repo rate. This brand new thing they've been starting. They started it in September, okay? And 102 billion. I'm pretty sure that's a record. I've been monitoring this, and me and some other traders are looking at it too. I'm pretty sure we're setting a new record. 102 billion, and they didn't want to be outdone. So, 102 billion, 94 billion, right there last Friday. And, right before that, we got 46 billion, 42 billion, 28 billion, 26, 15, 11. Is it just me or is it number going up? I thought taper went down. So, anyways, they are using this to have a heavy influence on the markets. They're trying to figure out how to force up the interest rates by doing this. Not quite sure how they're going to accomplish it. I've read a bunch of complicated papers on it, and didn't seem like it made a lot of sense. But it was 8 billion, 7 billion, 3 billion, 3 billion. And if you go further back, like to September, it was like one or two of these every couple months. Now it's every day, and now we're, it's almost like just who cares what the amount is? Just go for it. And so 102 billion. I'm just waiting to see $1 trillion in a day, personally. So I think that's Bernanke's goal. Let's see. But going out on the top with over 100 billion in the reverse repos overnight, just insane how high this is picking up. And just more people are joining in. There's 75 bidders that day. So people are catching on. They're like, what? There used to only be like 20 bidders, 12 bidders. But now they're all the way up to 75 coming in and helping bid in that operation. So, enjoy the party. So we'll see what happens. But, not a bad place to go. Go out on a high. And history books remember you for bringing the person who brought the market back up. And you can let the history books, in 20 years, remember somebody else who crashed it. Hence, Yellen. So, don't envy her. Not necessarily favor her, but don't really envy her either. But just some crazy, crazy stuff going on. We ought to see this impact more tomorrow. And not a big surprise. They're catching up because the holidays, they got to do extra because they're going to be closed for, New Year's Day and stuff like that. keep that in mind. Obviously we're going to have some holidays this week. Japan is on holiday today. Okay, so that can affect, of course, the yen. And we also have, obviously, tomorrow, New Zealand, Australia, China, Japan, Europe, Germany, all that's going to be going into holiday as well. And then on the 1st, it'll continue on over. Obviously, Switzerland, Europe, France, Germany, Italy, Britain, and then, of course, Canada, the U.S., New Zealand, and Japan and China also will be in holiday celebrating the new year. Switzerland wants to enjoy it a little bit longer, so they're going to go ahead and hold on that holiday into January 2nd along with Japan. And so this affects in the franc for a few days there and the yen. But just be aware of those holidays when they're coming up on the currency pairs. So a lot of websites you can check out, Forex Factory, investing.com, whatever, that list good calendars. But not a whole lot of high-impact news happening this week. So I was looking over the schedule and really didn't see anything noteworthy until we get to Thursday. So we will do, let's do a quick walkthrough on the week, though. And to see, like I said, nothing happening that's, that huge and dramatic. I mean, the news will always make a big deal out of the reports, whether or not they're a big deal. But, this morning we had pending home sales, and that was down 0.2%. And you know what? Reality, that has been a drag on the indices a little bit this morning. But, nothing just absolutely drastic. It's not like it knocked them or anything. So pending home sales were down a little bit. And tomorrow, let's see here on the 31st, we're going to have like Chicago PMI, consumer confidence. So, again, won't have a massive impact on the market. And, of course, be very light trading with early closing hours. And then we got the, first, everything's basically closed. Hopping over to the second of the month, that's when we start getting a couple reports. Like I said, one of those would be the British PMI. And so, let me go into the details on that one for you, and we'll see if we can find anything. But there's really, we're looking for, I'm trying to see if we even got that much. Basically a range of about 63 pips, high to low, with about a 53% probability of breaking 50 pips. So not even the best report. Right there on the pound, and then the ISM, and we'll, I'll take a little closer look as we get closer to it as well. But the ISM, we're going to have about a 60% chance of breaking 50 pips on major pairs like pound dollar, euro dollar, and we got about a 57 pip. Actually, that's a little over 57. It's actually 60. So we have 61 pips to be specific. Tradable high to low range right there. For potential news trade, which, sometimes you get this lower volatility on these holiday weeks. Sometimes you get higher implied volatility. So last week we saw a lot of higher implied volatility. I did notice that some of it had come down. But go ahead and look over at that. Those are really their only two trades for the week. And so pretty shocked. And usually what I do is I'm sort of cautious on news trades, especially during holiday weeks. Because you don't have your normal players in the market. And that's something, as traders, it sounds funny, but sometimes we're like, it seems to be the one few professions in the world where holidays are a bummer because you're like, man, the markets are illiquid and everybody's taking off and nobody's doing anything, and I just want to hop in and trade and make money. So it's sort of funny. That's almost, a mentality a lot of traders have. It's like, well, you should take off and just enjoy yourself. That's the whole point of trading, is to be able to take off whenever you want to. But you get in that mentality, and so you forget it. And all of a sudden you're in the middle of the holiday week, and you don't think about the reality. Okay, well, I know it's lower volume and higher volatility, but you don't think about the people that you're normally trading with, okay? The funds and the big guys and, just all over the planet. Everybody who's trading, a majority of them are not there. So what you're doing today is not what normally happens throughout the rest of the year, simply because the majority of those players are not in the market. And so that can, throw things off a little bit. And it's just, you got to keep that in mind. It's not the same. Last week, this week, a little bit different than the rest of the year. So it doesn't mean that, things can't work out for you. It doesn't mean it can't be a great trading day, can't be a great trading week. It's just something you need to be aware of. And, that's, again, another reason I like trading Nadex, because you never know, just with how, everything, works out, how it all plays out, what's going to be the best solution for your trades. and the ability to hedge your trades as much as possible. And there's a lot of ways to hedge on Nadex. One of those, I've taught us how to hedge the spreads. Another one I call it the double binary. If you really want to get into it, you may have heard of this if you're an option trader. Okay? It's called a risk reversal. So some of y'all may have heard of what's known as a risk reversal strategy. So today we're going to talk a little bit about what a risk reversal is and how you could take advantage of it. A risk reversal, in summary, we'll talk about just normal options, okay, and then we'll come back to Nadex. If I go over and, let's see here, let me pull up like Thinkorswim, okay? Go in here, I'll grab this, and we'll just pull this out right here. If I go in and I think that, the market, it's just been running and running, and it's at this high, and I just think it's due for a pullback, or whatever. Okay, that's just your mentality. Maybe on the S&P, maybe on the Nasdaq, whatever, but you're just, you have this concept that it's due for a pullback. Now, usually that would be, sort of a longer term basis, but if we go over here and just look at where we're at right now, let me and let's get rid of the studies. There we go. Okay. So right there, market's at, just made this big high of 1840. I think we're at the high. I think it's going to go down. Okay. And on the week, we don't even have to do this, so let's just play this on a weekly idea. So on the week, I just think it's not going to go and break the high this week or whatever. This would be a reason you'd do it. Like you're at a high or you're at a low. And so on a risk reversal, you'd go in and go, okay, well, and we pull it up. And you can try to pull up spreads. It's not honestly as good on futures for just pulling, random, verticals. But we can look at it. And the idea is to go, okay, what I want to do is I want to bring in enough premium to cover my trade. And so I'm going to do one more adjustment on here. Yeah, let me pull this. I'm going to close this down, and what we'll do is pull it up so I can actually put the trade in and show you what I'm talking about. Set to log in. So you basically want to play a bounce off what you think is the high, and so you want to go short. Maybe you want to buy a put, or you want to, do a debit spread. Put vertical debit spread. But if you're wrong, you don't want to pay for it. Okay? Well, by the way, if you're trading on Nadex, that'd be like buying selling an out-of-the-money binary. So let's talk about how to pay for it and how to do a risk reversal. Be right back after this break.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com. Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, so right now we're looking at what a risk reversal strategy is. And you could, of course, do it with naked calls and puts, but most traders don't have the margin, or and really just shouldn't be doing that. So we're looking at it using spreads, vertical spreads. And so for an example on here, what I've done is I've added in, if I was going to go in and I thought the market was going to go down. We're at 1845. I'll pull up a chart of the market here. This is just the SPX, more liquid than most of the other options out there, obviously, and being the major index. So going over here, throw this on, just a daily chart. There we go. And seeing how the high is at 1845. And so you think we're at the high, you think it's going to go down, but you don't want to pay if it just stays flat or doesn't move. That's your big problem. It's staying flat or moving. What if it just oscillates up here for like 3 or 4 days? And you don't end up, paying for that. So you think, hey, this week I think we're going to see a drop. I think we're going to have a bad, New Year's week or, whatever. And so obviously, I'm not even doing the analysis for you so much as going through, hey, you get these ideas, how can you take advantage of them? That's the point of options, is when I see something that I think is going to happen, what can I do to best position myself to take advantage of the trade and reduce, my risk in that trade? Well, if I was going to go in and say I want to do this, I could go and I could buy a put for the weekly expiration options, a put vertical spread. And people call them credit spreads and debit spreads, and the reality is there's no such thing as a credit spread. Some of y'all go, no, there's credit spreads. No, you get credited time in the sense of time is in your favor, but in either case, money comes out of your account. Okay, they don't put a deposit into your account and then take it away if it doesn't work out. They pull all the risk out of your account, and at the end, when you close it, if it's net positive, of course, you get that and more back in. So there's really no such thing as a credit spread in the sense of being credited money to your account, but time is in your favor. Well, if we're doing a debit spread, time is against us. And so as you can see, if you can look at this chart here, and I'll let me see if I can expand it out a little bit, make it as visible as possible. See the market being, right here around 1838, 1839, and the high being up here at 1845. Okay, so we can go in here. We can even add a slice, and you can put slices and all sorts of stuff in here. Let's see. If we had a slice on, we'll put this slice at 1845. Okay, so right there, and we're saying basically we think it's going to stay below 1845. Trying to make this as visible as possible. There we go. So we think it's going to stay below the high, because the high was 1844.89 on the SPX index. So we think it's going to stay below that, and we want to take advantage of that. Problem is, we put this trade on, market's at 1840, and the next week it really has to drop down to 1830, and then a little bit further, actually, down to 1828.92. Okay, so about 11, a little over 11 points. We have to have a drop in the market before we even get to break even. Okay, so that's sort of rough. 11-point drop, and I'm going to have to put up, quite a bit of money to do this trade. So, 100 times, whatever. So, if I want to do this trade, I got to put all that money up, and I won't even get anywhere in the profit zone until it's reached this point. Now, if it really does drop, which is what, you're banking on, okay, that's your trade, then, hey, you can make, up to $4,000 on this one trade. All right. And that caps out right there to, about 1825. So we're looking at the cap, because that's where our sold spread is. So it's going to start losing. The other one's making. So there's no more. Basically, you're just net neutral at that point. But we can make money here down from 1829 all the way down to 1825. So that's really our zone. That's our money zone where we want to make money. Problem is, we got those 11 points we got to overcome. So as an option trader, that's your massive risk. It's your movement risk. For you binary traders out there, okay, your problem is that you're out of the money binary. Okay, that's got to move, and it's got to move this week because it expires this week. Okay, you don't have forever to get around to this trade. It has to move. So how do we get rid of that having to move down? What if it just oscillates up and down 3 points all week and never really gets down there? What can we do? Well, we can sell. Now, this is going short twice, really, right? Because if we're buying a put, we're saying the market's going to go down. If we're buying a put vertical spread, if we're selling a call spread, then that means we're saying it's going to go down. If we bought a call spread, we'd be saying it's going to go up. So both of them are bearish. But one of them, we call it a credit spread, in the sense of crediting time to us. And we'll see what kind of impact this has on our P&L chart when we get back from this break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
With over 3 decades of trading experience, Andy Hecht brings a tremendous amount of knowledge and expertise to each weekly issue of his newsletter, the Technomental Commodity Report. The Technomental Commodity Report gives you Andy's unique technomental analysis of the commodities market, a combination of technicals and fundamental analysis which he has developed and perfected over his many years of trading. The Technomental Commodity Report is only $49 a month, and right now you can get a full month-long trial subscription while paying absolutely nothing. See for yourself the kind of weekly report Andy delivers to his subscribers every Thursday morning. You'll receive specific stock, ETF, and option trades based on Andy's analysis, so no futures account is required. For all the details and to start your month-long free trial to the Technomental Commodity Report, visit TFNN.com today. Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his Diagnostic Box Spread Analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, so we're going over risk reversals, and, maybe you get that feeling the market's going to be at a high, it's at the high, and you think it's going to go down. You want to play it, you want to choose sort of an out-of-the-money put, or you want to choose the out-of-the-money put spread, and you don't want to have for it. So I visualize, I add these slices to the chart so you can see what's going on. We got where the market is right now, this line right here, okay? And let me get rid of that. And then we got basically where, we're saying it's going to stay below the high here. But to, get a decent price spread here, we're looking at him to go in, and the market has to drop down to 1828.99 for that to happen. Is that possible? Yeah. But it has to happen this week, and by the way, don't forget, we're losing some days on the week, right? So it has to happen pretty quick, and we can back out and even look at this on a daily time frame and see if it makes sense to us, and, all that fun stuff. But we zoom on back in on here, and we're basically going to say that it has to trace back to this point, and the lower it goes, the better. And we'll cap out right at, this level. Let's see, right there at about 1825. Okay, so that's the most we're going to make, is from 1829 down to 1825. But if it stays where it's at, we're going to lose everything. We're going to lose all of our premium. So we're going to pay for it. Okay, so a way to pay for that would be maybe to go in and we're going to add on a vertical spread. We're going to sell a credit where time is being credited to us. Okay, and you got to put up a risk and all that. Either way, but we're putting up that vertical credit bearish call spread, and we're receiving income for it. So, if I go in and I can update these, like live right now, looks like we get a $1.65, okay, if the market stays below 18.45, okay, which means if it just stays where it is right now, goes up to pretty much 18.45 or goes down, we still can actually bring in a decent profit of about $650 as of expiration. And that profit can go even higher as it keeps going further. We'd actually net a $5,750 credit, $5,700 credit on this trade for a max profit if it went down, we held it, and it expired below the max profit level. So we could add one more slice here. And let's see, we'll add that slice on just so we can see it on the chart. And that slice is going to be our lower strike of 18. Yeah, let's do this one. 18.25. There we go. Put those slices on the chart. There we go. So this is our range. We're going to get max profit. But the cool thing is we actually get to make profit between 18.45 and even 18.28 by adding on a credit spread. The market can move up 5 points against us. We still could be profitable. The market can, stay in a range. We still can be profitable. The market really moves down. We have actually a really nice profit ratio. And we look at this, we're like, okay, well, our max profit on this is, based on, I got live pricing. I probably need to lock that down so I don't keep changing the numbers as I'm talking. But our max profit on the trade is $56.50, and worst loss is $43.50. So we got a better than a 1-to-1 probability, okay, on a weekly trade. If the market goes against us, the most we could lose would be $43.50. That's 10 contracts. You could make that one and make it $435, okay? If it just stays flat and nothing happens, we could make $650, okay? But if it flies down, if it thinks what we think it's going to do, then we could really cash in on the trade. So this is how to do a risk reversal on options. You can do this on any kind of option, anything that's optionable, you can apply this strategy. It's pretty cool. It's a way to give you a nice range, premium collection area when you think you're at a major turning point, such as a high or a low in the market or whatever. Now, as it goes up, of course, there is, risk of loss. Notice you don't get your max profit immediately. You're going to get it at expiration. Of course, as time goes by, that whole curve changes. Same thing on the way, up. So if the thing would just started, let's just say today the market just started running up and ran up 5 points, okay? Then you could hop out of the trade at about $1,000 loss. But remember, you had a $5,000, almost $6,000 profit potential in the trade. So you could decide to get out of the trade, which is often a rule that I'll use on any kind of strike, premium collection strike, etc. Is if it hits my in the money, like if it goes 1 cent in the money on my strike, a lot of times I'll just bell because I was wrong. And you know what? It doesn't mean you have to bell on the trade completely. You just roll it now. Okay, so now you can go in and do another vertical. Okay, you could leave your original one on because it's got hammered pretty well. You can just look at how much value's in there, but you could also go in and do another risk reversal and put it higher and roll that vertical up. And there's ways to go in and turn this into butterflies as things change. There's a lot of cool things you can do with options. And you can also do this with binary options. Okay, do this same risk reversal strategy. So to look at a comparison between the two, and one, you can do it with less money. So well, why would I do it with binaries? Well, one, maybe you don't have that much to throw up there because you got to put all that money in. And if you're going to do like that kind of trade, you could be putting up a lot of cash. So it wouldn't be just exorbitant, but it'd be more than you'd have to. And you can also do this intraday. You can do this daily. Okay, so there's a lot of reasons why you might be interested in actually pulling this off, maybe on, say, a Nadex versus doing it on the actual options, or you're not actual. They're both options. One's a vanilla option. One's what you call an exotic option. Okay, and so we'll go in here and we'll look at this, and let me pull this up for you. There we go. All right. So now let's just get sort of a similar thing going on here. And we'll look at the binaries in this case. We'll look at just the S&P. Okay. I'm going to clear my filters out here. I'm just going to make them what I call 5 to 95. That basically says show me everything except for the stupid stuff. That's all the way on the outside that I'm not interested in. And in this case, we're going to take a weekly look. Okay. So we're going to go over here to the weeklies. And once we pull that up on the weeklies, then we're looking to sell, right? So we just want to go short on this trade. Okay, because we're thinking the market's going to go down. And I can go down here and I can see, what's possible. So what is possible? Well, I need to be able to bring in a premium that would pay for my debit. And so I can look at all that. Now, they're going to be very wide strikes. To really get a perfect comparison, we need to pull up the S&P and all that. But just to show you, to sort of a cross comparison, okay? And what I'll do here is I'll just throw the S&P chart up so we can get a little bit closer there. So we got 1840 versus 1845 being the high, see? So it's a little bit different scenario. But you could go in, and so if we subtract 5 points off everything we were looking at before. So if we're looking at 1845 as being the high, now we're looking at 1840. Well, I can put this a couple points above 1845, and for $20 credit. Okay? Now I could do 1, 2, 10, 100 of them, whatever, but it's a $20 credit. Now, to make it where it would be profitable, we'd have a risk profile over here like this. Okay? So where I'd make money if it stays flat, moves up, or moves down, then what I need to do is go in and find one that gave me the ability to get that equalization. So I could go, well, right now I can see for a $20 credit, the only way to be net profitable if it's flat is like the 1811. So remember, we are moving everything down a little bit. So 1811 right there, $85. All right, so what does that mean? Well, if I bring in $21 on the trade, it'll cover the maximum $15 loss if the market stays flat. Because what's happening is I'm saying the market will stay below 1847.5. So we're really high up here. But it'll stay below 1847.5. And if it does, then I'll make $21. Okay? Now, if it gets to it, I can get out of the trade, pretty much at 50, so I lose like $30 on the trade. Now, down here, I got this one, and it cost me $15 because I'm saying the market's going to go down. Okay, so instead of like risking $15 and hoping it moves all the way down, I'm saying it's going to go down, and for that, I must risk $15 to do that. Well, what if it doesn't go down? What if it goes down a little bit? What if it only goes down halfway? What if it goes up a few points? What if it stays flat? How do I pay for that $15? So I'm not just throwing money away on out-of-the-money options. But I'm still able to participate in that big upside. So you want the best of both worlds, right? You want to not have to put up all that money, but really you want that big profit is what you want on the ones that move far. It's not even about so much how much you're putting up as it is I want that nice profit on that lower risk. And you can make $85 on the trade. Okay, so we can make $85 right here. And there we go, get rid of that simulator. Make $85 on that trade. And that's not bad at all. So I get $20.50, I pay $15, $16 there. I'm going to collect $4 or $5. That's basically what that's going to ensure is I make a little bit if nothing happens. Okay? If it goes up, I make a little bit if it goes up. Some. Basically, if it goes up, like, say, 7 points above the current high, which would be about a 14-point rise in the market. For me to begin to potentially lose on this trade, it would have to go up about 14 points against me right now. Okay? Between now and Friday. Definitely possible. The market could definitely move that far, but that's what would have to happen for me to even be worrying about a loss on this trade. Okay? If it goes down, I make a little bit. Now, if it really goes down, if it just starts hammering it and it starts flying down, then I can make a lot. I could make $84 on the one I sold. I could make $21 on the in-the-money one that I sold. So I could bring in, a little over, about $105 on the trade. So, or $1,005, or not, you can exponentially grow the number as big as you want it to go. But it allows me to do this. Now, the cool thing is, like I said, you don't just have to do this on a weekly time frame. Maybe you don't have time. Maybe you do want to do it on a weekly time frame. Maybe this is like a Monday morning strategy or Monday night strategy. You want to put it on. It's there for you. Now you can take advantage of highs and lows on all different markets across the board, and this is a way to do it. Now, what's my worst case scenario? Let's say I didn't take a stop, I didn't get out. What's the worst thing that can happen to me? Well, remember we said the best thing was we could make $105, right? Well, the worst thing is we could basically lose about $105. So we're literally at a 1-to-1 risk-reward ratio on a trade that has to move 14 points against us for us to lose on the trade. Makes a little bit if it stays flat, but we can make some nice profit if it really does move down. Now, that is on a weekly time frame. We can go in, we can back this down to a lot less. We could go to dailies and see, what exists on the daily time frame. So now you go in here, and now you're, getting a little more specific on your charts. You're getting down to intraday time and looking at, we'll say, 15-minute bars. And we got the market up here at 1840, and you're trying to figure out what to do. How do I take advantage of it? This is 1834, it's 1836. So you could go in and say, okay, well, I could sell the 3015, collect $30 if it stays down below 1836, because I think it's going to head down for the day. And if it keeps dropping, I went to pay $9 on this, so I'd collect about $20. And here's one of the cool things, is it goes up. Let's say it hits that 1836. Your $9 sell is probably worthless. Okay, your 1830 contract that you sold originally, probably worth nothing. So there's no reason to exit from it. So if I sold for $30 and it goes up, and if a market hits 1836, it's basically worth $50. So I lost like $20 on the trade. Okay, and then I'm down $9 on this side, so I've lost $29. But I leave the other one on. Okay, because remember, it's that like max loss. I'm pot committed. There's no reason to cash out the trade for $2. And if it flies back down, not only can I make back the 20, but I can make a whole lot more. So it's a very, very cool way to hop in and start taking advantage of some of these trades. And you can even do this on a shorter time frame. You can go down to intraday, and you can see what exists. And you can go and you can start looking at it and start going, okay, well, I like this one, 1835.7, 1831. And you go over and you look at the trades, and you're okay, I think it might move down in the next hour and 11 minutes, whatever. And it's not about I think it's sort of funny when you hear somebody talk about an hour or minutes. I know as a trader, when I first heard this, I was like, whatever. But you're doing the same thing when you say days and weeks. Okay? You're literally doing the exact same thing. Well, I think, by this time when I choose this option for this expiration, this is just faster, but it's the same thing. And one of the things I'll get is people go, what? I just don't understand how those things are priced. How do they price those binaries? All that. Well, there's sort of a simple way to find out. Okay? So this is on a little different topic, but hopefully you picked up the risk reversals there. But I'll show you a way to look at how they actually price these binaries. Right when we get back from this break.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Have you subscribed to the Gold Report yet? On Wednesday, August 14th and Thursday, August 15th, Tom O'Brien advised his Gold Report subscribers to close out 6 of their 9 open positions, all winning trades ranging from a 10.69% profit to an incredible 48% profit in just one equity. Tom O'Brien brings an incredible wealth of knowledge and experience to the gold market and the equities within the industry. That's almost 12 years since this powerful newsletter first began. And right now, you can get a 30-day free trial to the Gold Report by visiting TFNN.com. Make sure you're a subscriber as this volatile gold market makes its way back into positive territory after declining all the way from $1,900 to under $1,200 an ounce in only 2 years. Get your 30-day free trial today by visiting TFNN.com.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, we'll come on back here to the Diagnostic Trading Hour. So one of the objections, or maybe just simple questions I get, is how in the world do they price these binary options? Okay? And you've heard me say before that the binary price is a reflection of probability, not like an exact probability, but it's very much a reflection of probability. And they do use a Black-Scholes model. Okay, it's not the standard, but it's based on a Black-Scholes model. And the actual net result is pretty interesting. Interesting if you're into option pricing. But the net result is that the delta of a equivalent strike, okay, is basically a binary options price. And if you think about that, what is delta? Delta is not 100%, but it is a reflection of probability of that strike expiring in the money. Okay? That is, I know that's not the technical definition. The technical definition of delta is the rate of change of the options price based upon a 1-point move in the underlying market. Okay? However, it is also a good gauge of quick and easy probability. And so what I have found, and researching this, going through it, is if I go over and I look at, you got to get as close as you can because sometimes the strikes don't always line up perfectly. But when you're looking at all of them, then what you'll notice is that they'll line up on the different strikes there. I clicked the wrong button there. And the prices will line up with a delta. And so let's go back up and we'll look at, we were looking at weeklies. So we'll look at weeklies over here because we really don't have any much, left that we can do with that. But right here we got weeklies. They got end of month also, which is something you can play with. But on the weeklies, we go in and we go, okay, let's find a close strike. 1823. What can we get? We can get an 1825. All right, so we're getting about a delta on an 1825, pretty close to 1823.5. And look at the delta right here is 70, and the price is 68.50. And again, we're a little bit off, right? Because there's about $1.50 difference there. So you'd expect the delta to be up, but look how the delta and the price of the binary line up. And then we go in and we can look at a couple other ones. See, is this a consistent thing? What if we go to 1835? Okay. So if we go over here to the 1835, we go over here, 1835, and what do we got? So 1835.5, so again, a couple ticks off. We got 44.50. If you add in the bid-ask spread, it's going to be about the same, but 49. So very, very close. And, it just continues on the further and further you go into it. We got 1859.5, so we go down here to like 1860, okay, right here. We got a delta of 8. Look at the price over here, $10. So within just a fraction, okay, drop the decimals off. With a fraction of, a couple ticks here or there, and you can account for that with bid-ask spread, differences in applied volatility, whatever. But bottom line, they expire at the same time. And this is important, okay? They have to expire at the same time to look at this. You can't go look at an intraday one that expires at 2 o'clock and try to find that strike on the weekly contracts on the S&P and think they're going to line up because they're totally different. But if they expire at the same time, like the weekly's expiring at 4:15 on the S&P E-minis, the weekly's expiring at 4:15 on the Nadex binaries, then those deltas on the vanilla calls there, the deltas are going to line up with a binaries strike price. So not just the strike itself, but the actual price of the option. And so the only reason I show you that is to show you it's not just like randomly picking what they're going to charge. And when I say they, I mean like market makers. Nadex is just an exchange facilitating transactions between buyers and sellers like the CME. But where does that price come from? There actually is a place it comes from. Okay? And it's basically the delta of, if you've got a call strike that expired at the exact same time, the exact same strike, the delta of that call strike should equal the price of the binary, which means their gammas also match up. All right, y'all have a great day. See you tomorrow.
Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com. Eastern legend tells of a fair maiden who was offered a rare gift by the king of the land, a bag of pearls. The king promised that she could keep the largest, most perfect pearl she could find with these 3 conditions. 1, choose only 1 pearl. 2, remove 1 pearl at a time, accept or reject it. And 3, if rejected, it would be lost forever. She began by looking at the pearls, passing on many special treasures. She delved deeper into the bag, and soon the pearls were replaced with pebbles. Sadly, she went home empty-handed. Folks, replace pearls with time because we cannot go back even 2 seconds. We live in the eternal moment of now. So when now are you going to take advantage of my offer to you, a subscription to my daily investment newsletter service, Mastering Probability, where you can experience the most incredible pearls for trading and investing, the Rhodes Momentum Indicator and Strategy. The offer? It gets better. A 30-day money-back guarantee. Don't go home empty-handed. Mastering Probability. Available on the homepage of TFNN.com.